We're going to do a brief video on short selling, and we've got Tesla up here with a daily chart, 5-day moving average in green, a 20-day moving average in red, and a 200-day moving average in blue. Now, the first thing you want to understand about short selling is it's absolutely no different than buying. It's just the exact opposite. There's no hesitation. There should be no hesitation to sell short, because there's huge opportunities in selling short, and I'm going to show you why. The first thing, when we take a look at this stock, the first thing to keep in mind is stocks are not necessarily the best security to sell short. And I'll show you other opportunities and other securities in a moment. But I'm using Tesla because it's very volatile, and I can show you a daily and hourly chart and show you the basics of short selling, and it gives you opportunities to do both. But oftentimes the most lucrative things to sell short are commodities, indexes like the SP 500, crude oil, gold. Those things are a lot of short opportunities there, and it's a different game, which I'll explain to you in a minute. Keep in mind, when you're buying or shorting a stock, there's a specific number of shares of a stock outstanding. And if you get caught in a move like this, let's say you went short right here at this roughly 268 in Tesla back in October of 21. That would crush you on a short sale. So let's first explain selling short. Selling short means the selling of something you don't own. Now, at first that concept seems weird, but it's done every day. If you go to a car dealer and you put in an order to buy a new car, the dealer has sold you that car short. He doesn't own it. He takes your order, he sells it to you, but he doesn't have the inventory. So then he places an order to buy the car from the manufacturer at a lower price, and he sells it to you at the higher price, and he makes the difference. So it's the same thing with stocks. For example, let's go back here. If you sold Tesla short at 260, you could cover it all the way down here. Let's say you covered it at 190. You'd make the difference between 260 and 190, or $70 profit. Now you say it can't be that simple. It's exactly that simple. Instead of putting buy in your order on your electronic platform to buy Tesla, you just put sell. And then since you don't own it, they know it's a short position. Your account may have to be approved for short sales. You have to have the money in there to sell short, just like you have to do to buy. But the point of it is, it's that simple. The difference when you're using stocks compared to commodities or indexes is that commodities and indexes, people write contracts to open new positions. So you can't get squeezed. You can get squeezed, but not in the same way as you can in a stock squeeze. You have to actually, your broker actually has to borrow stock to give it to you, and then you sell it short. That's not the same thing that happens on a commodities exchange or an index. And so you want to understand that I do not recommend shorting stocks. In a minute I'll show you the way I would recommend going short stocks without actually doing it. You use options, you use put options, and we'll discuss that in a minute. But if you were to sell this short, you would just simply open up your brokerage platform, and again, instead of putting in buy, you'd put in sell, and you'd be short the stock, assuming you had the permissions and assuming you had the money in the account. And before we continue, let's make sure we're clear. You do all this at your own risk, and everything I'm giving you is for entertainment purposes only and is in my opinion. So let's take a look right here. Let's say that you went short at any of these opportunities here. Let's just put a line across here at 288. I'm sorry, 388 for Tesla. You could have gone short at any of these opportunities, selling into these rallies, or even selling these declines, and you would have made profits of on the order of $40, $30, $40, $50 on any one of these per share. So there's no prohibition on selling short except an emotional one, a psychological block. The professionals think of going short in the same way as they think of going long, most of them, the ones that are sophisticated. There's absolutely no difference. Instead of saying buy on your entry, you put sell. If you don't own it and you hit the sell button, you just went short. So that's pretty much how it works. Depending on your brokerage platform, there may be some slight differences, but that's essentially it. If you sell something you don't own and the price of that goes down, you profit. If you go to buy something, you now have control of it, and if it goes up, you profit. The two, it's just the concepts are absolutely the same. So if you keep a look at this, take a look at this Tesla stock, you can see this was a buy opportunity, 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 but you skipped 50% of the profits in here or more, because this was a sell opportunity, sell opportunity, sell opportunity, sell opportunity, sell opportunity, sell opportunity, sell opportunity. There's an incredible number of short opportunities on here. So to short, is to take advantage of another 50% of the opportunities to make money buying or going long. So to not have a short mentality in your repertoire of trading and investing is to be deficient by, in my opinion, at least 50% and not more. You really can't understand the markets unless you understand that professionals are going short. That's what they do. They buy, but they also short. And so just like a car dealer buys cars and sells them to you off the lot, they also sell you cars short by selling you cars that they don't have on the lot. And it's the same exact concept in the stock market. Now let's take a look at Tesla a little more closely. If you look at a daily chart, there's a lot of opportunities. This is an hourly chart. A lot of phenomenal opportunities are available for selling short intraday, meaning day trading. This, again, hourly chart. If you own Tesla, you'd just be agonizing this whole time as it went down. But if you were a trader and you were neutral on Tesla, you could take this opportunity, assuming your own analysis said it was a good idea, to go short Tesla and go from 309 roughly all the way down to 269. So almost 40 bucks. There's no, and that's $40 in Tesla from August 16th to, let's just say, September 2nd. So a couple weeks and you've got a $40 opportunity to sell Tesla short. Again, you could then switch right around and go long Tesla and buy down here 268-ish, cover around 308, and pick the money up there. So you can see that by not shorting, you're losing tremendous opportunities. This is a lot of people who own Tesla would think of this as a disaster. When I look at this as a beautiful short opportunity. And there's a lot of technical reasons why I say that. But if you were short right here at 308, you could hold on all the way down here to 216. Make yourself $90 on a short trade. So the first thing to understand about shorting is no different than going long. It's just the exact opposite. You didn't own something, you bought it. That's a long. You didn't own something, you sold it. That's a short. And you get out of it the same way, just the exact reverse. If you buy something, you sell it. If you short something, you buy it back. So you short at 307, you buy back at, say, 210. And you're out of the trade. Now, again, there's practicalities. When you're trading stocks, there's practicalities. Your brokerage account has to be suitable to be able to do all this. So let's switch real quick over here. We're on Tesla, but let's switch real quick to something most people don't understand, and it's actually very simple. Switch to currencies. Now, at first, currencies seem to be overwhelming to the average person, but you want to look at currencies in the same way as you look at a share of stock. And let's go back here. People are buying and shorting currencies all day long, regular traders. And the reason they do that is there's not anywhere near the prohibitions or restrictions on selling short for currencies as there might be for stocks. And it's also not the same risk profile. Again, it could be even riskier. I'm not trying to suggest that it's not risky. It is risky to do anything in these markets. But you can see here that if you're not selling short from this period of time here, and we're on an hourly chart, if you're not selling short here, you've got from October 3rd all the way to October 4th, so 24-hour period of time, when essentially you had one decent trade. Whereas if you're selling short, you sell short here, you buy here, you sell short here, you buy here. That's 4 different trades. So you have to understand that you're really robbing yourself of huge opportunities when you're not shorting. I'm not recommending shorting. I'm not recommending buying. I'm just explaining to you that the concept of going short and the mentality of it, there's being something wrong with it, is a mentality that comes from not understanding it. Let's go back to a daily chart again real quick and take a look at another stock and see how much money you could not make by not going short. Let's take a look at Tesla again. And we're going to see if we can pull it up right here. We're going to go to a weekly chart and we're going to see if we can cover this stock. Well, I want to cover it. You take a look at this stock right here. This stock is split adjusted now. This is $400. This is $212. It's $180 in Tesla movement down. The people who bought here and didn't sell watched it go all the way up and all the way down. And there's a lot of people that held Tesla. If you'd bought Tesla here down at 190s, you could have sold it at the 380s, 385, 390, and then shorted it all the way back down. And that's what the sophisticated investors are almost certainly doing. Again, put your buy order in and you own it, sell it, and then sell it again. You sell it to cover your buy, sell it again. Now you're short, and now it goes all the way down. And again, the caveats are you have to have your money in account, you have to have permissions and so forth. With stocks, it's a little bit harder. But futures contracts and currencies, it's as easy. It's just a absolute piece of cake. So that's the basic tenets of shorting. Now, why is shorting so attractive to professionals? And the answer is contained in this right here. This Tesla was $297, and here at this drop was $185. So that's, let's just call it $10 drop in about, what is this? January 25. We're on a weekly. So this was about from January, let's call it February, the 1st of February to the 1st of March. So 30 days. And you made all this opportunity here. To get back from this low all the way back to this high took from this point here, May 17th, all the way to October. So what's my point? My point is that shorts enable you to profit very quickly because the markets decline much faster than they rally. And if you look over and over again, you will find that in general, markets decline. Look at this. This from $62 to approximately down here, whatever this was. Let's see if we can see it here. $21. $64 to $21 happened in what? February to March, about a month. But it took the market all the way to here to June, from March to June, 3 months to get back that amount of money. So shorting, you make money very, very quickly, assuming you make money, and that's a big assumption. You make it much bigger than you would in a bull market. And of course, there's always exceptions. You can see this is a very steep rally, but look how steep the sell-off was. The sell-off was much steeper than this rally, and so forth. So the general rule is markets sell off much faster than they climb. And so that's another reason why you would sell short. Now, if you're interested in shorting stocks, for example, why do I not recommend you short stocks? There's a lot of technical reasons that are too detailed to get into. But in general, you can profit from shorting stocks by just simply buying puts. Now, to get into options, it's too much to have a discussion on options trading. But basically, if you buy a call option, you're buying an option to buy the stock. But if you buy a put option, you're buying an option to sell the stock short. Now, if you already own the stock, you can sell it. But if you don't own the stock and you buy a put, that's a synthetic short. You're now short that stock without the risk of the stock continuing to go up. Keep in mind, when you buy a stock, the risk is that it'll go down and you lose money. When you short a stock, the risk is that it'll go up and you'll lose money. But if you trade with options and you short a stock by buying puts, you're short that stock with a defined risk. Let's say you paid $1,000 for the option. You can't lose more than $1,000, but you can conceivably make a lot more than $1,000 on your option position. If you short this stock in what would be called a naked short, you just short it. You go in your brokerage account and you sell something you don't own, and let's say you sold Tesla here at $289. If it went to $300, you lost $11 a share. If it was an option, the only thing that would happen is you might end up having an option expire and you lose your premium. But if you sell a stock short, a lot of people have probably sold that stock short at that same level. For example, right here. This 239 level was a good, reasonable place. A lot of people would have said, hey, I can short the stock here. But look what happened. The next day it went all the way up to 294. So you had 239 high and the next day 294. If you shorted Tesla here at 239, you would almost certainly get a margin call unless you had a lot of money in your account. So shorting is extremely risky if you don't know what you're doing. It's risky if you do know what you're doing. But you can minimize your risk to shorting, or at least define your risk at shorting by using put options. Now, you can use put options in general on stocks, currencies, futures contracts, and put options are obviously a way to define your risk. There's a lot of other things that you have to have for full disclosure. You have to pursue all of those things and learn about options. They're risky too. You can lose all your money with options as well. But the point is that you can limit your risk in the stock market by buying put options if you want to go short the market. And because the markets fall so fast, you don't have the same amount of time decay. Now, there's other tricky things with options. You don't want to overpay for them and so forth. It's beyond the scope of this video. But options trading, in terms of buying puts, can sometimes be a very lucrative way to trade because the market falls so much faster than it does when it rallies. And it takes a long time for it to climb and a short time to fall. Sometimes you can get good deals on put options, and that can all work in your favor. Of course, this is all for entertainment purposes only, all my opinion. You have to do your own research and analysis. But that's the basics of shorting. You can short almost anything, either directly or synthetically. And again, when you're using options, that would be an example of a synthetic short. You can short, as we said, crude oil, gold. You can short most of the commodities. You can short the treasuries, which means you can synthetically short interest rates, both with futures or with options. So there's virtually very few limits on things that you can short, and your shorting positions can be extremely lucrative if a market's in a deep bear market. A professional trader doesn't care if a market's in a bear market or a bull market in general. That's a general statement, but it's pretty much true. They're going to look to make money no matter what. They're going to look to make money when the market's going up, and they're going to look to make money when the market's going down. And that's a mentality that is a very healthy mentality to have, because if you look for the opportunities to go short, you'll not only find them, you'll find synthetic ways to go short that can theoretically reduce your risk. So the way to pursue this, as far as I'm concerned, my opinion, is to contact your broker and start to discover what your options are for selling things short. Again, I would be very careful shorting stocks. I don't recommend it because there's some technical issues with stocks, the way they have to be borrowed by the broker and so forth. But you could certainly use puts. There's other synthetic ways you can do shorts on stocks, and your broker can help you with that. If you wanted to get involved with shorts and you wanted to do it directly, then you can do those of course with futures. Futures contracts are opened up as you make them. And so if you, for instance, if we go to crude oil here and take a look at crude oil futures, when someone buys, let's say right here at 76 bucks, they buy crude oil. Someone sold them that crude. That moment that contract was opened. So there wasn't an existing contract in general, that contract was just written. And so the buying and shorting of commodities like crude oil are not subject to the same technical considerations as you would have on stocks. Keep in mind, there's usually a definitive amount of stock out. There's not a definitive amount of futures contracts out. They expand and contract every day as they write new ones, and the old ones close out. So it's a different market, and I think an easier market, and in my opinion only, for entertainment purposes only, safer to engage in short behavior in the futures markets than it would be, for example, the stock market. But again, that's my opinion for entertainment purposes only. So that's a brief discussion on how to sell short. And I think that a trader who doesn't understand selling short cannot possibly understand how the markets work, because the short covering is responsible for a lot of rallies. So when you hear them on commentary on TV talking about a short covering rally, this is a short covering rally to a modest degree. This market sold off, and people made profits when it sold off because they sold it short up here. So as we discussed earlier, when you sell a market to get out, you buy. When you buy, you drive the price back up. And it's the same thing right here. Somebody sold this market. A lot of people sold this market right here, right up. We could go all the way up to the top here, this $130. So let's say they sold it right at 130. They covered down here. They probably covered on the way down. But this covering is what drove this price up here. And you'll notice that's why this price dropped back down. Once these short covering stops, the price drops back down. These are new buyers down in here. But these people were people who were covering short positions that they put on up here. And of course, there's losers in here too. I don't want to confuse anybody. There's always, at any position in here, there's people who are losing money. And at any position in here almost, there's people who are making money. But if you sold short here at 130, you're going to cover and make your profits, and your covering, your buying, is going to drive the price back up. So that's what's known as a short covering rally. And you'll notice the minute it was over, the market drops down, and then real buyers, more longer term buyers come in the market, and it slowly starts to go up again. Same thing. At this point, the short sellers come in, they overwhelm the buyers, they drive it down, they take profits here, and the market rallies. As soon as the short covering rally is over, the longer term downturn trend continues. So this can be short selling, and it can also be people who were long selling out at a loss, or maybe they bought down here, taking their profits. So it's very important to understand short selling if you want to get a sophisticated view on how markets trade. Without short selling, there would be no successful markets, in my opinion. Now, I'm not a college professor. I don't, that's something different. You can read studies on that. But in my opinion, you must have short selling to have a liquid market. Whoever wants to buy has to sell to somebody. And you need people who will sell who are not in the market currently. In other words, you need short sellers. So that selling short is critical to understand why the markets trade the way they trade. You don't have to ever sell short, just like you don't ever have to buy. But I do think it's important to understand that short sellers are extremely active almost all the time, and they're making markets and making profits, and those opportunities just might be available for you. A study of this is just an introductory video, but a deep study of shorting and how to short with your broker and reading all the disclosures and understanding the risks is a good idea, even if you don't intend to sell short, because it gives you an idea of what's going with the markets. Why does this market rally so hard and then fall right back down? It's really simple. Almost certainly short covering. And when you understand that, you realize that if this is short covering and I want to buy this stock, maybe I just wait until it comes back down again, till the shorts cover, and I'll get a better price. So an understanding for buyers an understanding of short selling is critical for buyers, especially for traders who like to buy as opposed to short. I think that a repertoire for a trader has to include, even if you don't want to short, you have to understand shorting to understand the market. And the other thing to keep in mind is we're looking at let's go back to Tesla. We're looking at daily charts there. When we go to Tesla, Tesla's not a good one for a 1 minute chart, but this is a 1 minute chart. And you can see here very easily that if you don't understand shorting here on Tesla, you're not going to understand why this market's going down. People are shorting this stock and driving it down. There are people who bought it and now are losing money and they're driving it down. But the reality of it is short sellers can at times, like right here, can be controlling the market along with people who are liquidating. The liquidating patterns look a little bit different. You can see that this is a lower low to this, and this is a lower high to this. This is liquidation. These are almost certainly buyers that are liquidating positions at a slight profit, and then they begin to panic sell as they lose. So understanding short selling, the difference between short selling and buyers liquidating losing positions, is critical to understanding the structure of the market. None of this is predictive, in my opinion. None of it may cost you money, but at the end of the day, if you're a professional in the markets, and when I say that, I don't mean someone on Wall Street, but if you're a person who's in the markets buying, trading stocks, it's important to understand short selling, because it is at least 50% of what's going on in the market by both professionals and unwitting short sellers. There's a lot of people in here who really don't know what's going on, and they're aiding short sellers by pumping the market up to abnormal highs, because when you pump a market up to abnormal highs like this with huge gaps, the short sellers are going to jump all over this and drive it down. And they may initially drive it to here, but then the sellers of stock who bought here and are losing money here, they're selling it down here to cover their losing positions. Keep in mind, whether you want to sell or not, a lot of people get margin calls and they have to sell. Some of this is liquidation by their brokers. They simply don't have enough money in the account, and their brokers automatically sell. And that's why you get a lot of really weird looking trading as prices decline. The rule with trading is, in a good market, anything can go up. But in a bad market, almost everything will go down, because they're going to sell the good to cover margin calls on the bad. It gets nasty real quick. So it's hard to think of this as logical selling. It's not necessarily logical selling. Some of this could be just forced liquidation by the brokers from people who bought right here, or maybe bought here. So you have in this decline, in any decline, a combination of short sellers and buyers taking a loss, and forced liquidations by their brokers. So that's why it's very important to understand short selling, to understand the other side of the market. I recommend you talk to your broker, read up everything your brokers have on their sites. I don't recommend you short sell. It's not easy in any way, shape, or form, and you can lose a ton of money. But I do recommend you understand it because it'll make you a better investor or trader. What we do at rbamresearch.com is publish 190 entry prices for stocks every morning before 7 a.m. These are the ones that are currently out today for the 14th. We, for stocks, list buys only. In a minute, I'm going to show you some shorts. So we have 1, 5, and 20-day holding periods. Most of these are zeros today because the market, the algorithms that generate these didn't think today was a great day to buy stocks, and in general, it's been right. But you can see the Smile Direct Club has some entry prices and so forth down the line here. Let's find something. Uber is here at $23.85 and so forth. These are buys. I'm going to show you here now. We put out shorts every morning. These again for Friday, October 14th. This is a moving average system that puts out shorts. It's a 30-day hold. And this particular system, buy flats or shorts. And you can see today it's listing shorts for the SP 500, Apple, Tesla, Ford, and so forth. There's a buy on General Electric, gives specific entry prices. And again, if you wanted to short the SP 500, this is for the futures contract. If you had a contract with your broker and you knew what you were doing and you're taking your own risks, of course, you're all for entertainment purposes only on here, but you could short at this price, and that's no different than buying General Electric at this price. In other words, it's just the exact opposite. You would have no position in either. If you bought General Motors, you're long General Motors. If you didn't have a position in the SP 500 and you sold it, you would then be short. And again, these are all for entertainment purposes only. Can't use them for real live trading. You have to do your own analysis. So this is an example of what we put out. Buys up here, and we put out buys and shorts here every day, Monday through Friday before 7 a.m. Now let's take a look down here and look at forex. So what we're going to do during the week, again for entertainment purposes only, is we're going to put out 1, 2, 5, 10, and 20-day holding periods for futures. Cash forex, gold, and for crude, and I'll show you those in a minute. You can see here, here's the euro against the dollar. These are daily holding positions. So if you get in today, assuming your own analysis says it's a good idea, you would get out at the end of the next trading day just before it closes at a loss, or take your profits sooner if you got them. And if you looked at the one-day hold period, it's recommending a short for entertainment purposes only at 0.9723 for the euro versus the dollar. It could have just as easily recommended a buy as it does down here for the Japanese. This is the US dollar against the Japanese yen. So buys and shorts are listed on here directly. It's going to have one or the other every day, Monday through Friday, because in our mind, there is no difference. It's a trading opportunity. And again, entertainment purposes only, you have to know what you're doing and you trade at your own risk. But that's how these work. The holding periods are basically whatever you want to do in terms of holding in general. Hypothetically, these are going to produce higher win rates the longer you're willing to hold it. But the position of going buy or short is, we're indifferent to it. That's why we post either or every day. You go down here and take a look at crude. You can see no buys for crude today, but we do have shorts. Same thing, 1, 2, 5, 10, and 20. So we're saying there's no buy opportunities today, again for entertainment purposes only, but look, there's short opportunities. So rather than doing nothing today, you at least have a chance to make some short opportunities. And you go down here for the gold, the same thing, no buy opportunities, but short opportunities. And the same thing for Bitcoin. We put them out. Bitcoin is harder to short. I'm not really, most people probably aren't going to be able to short Bitcoin, but we put them out here anyways. And of course, there's no buy opportunities according to these today, but there are short opportunities. And then we go down here to the S&P 500, same thing. Didn't list any buys, but we listed shorts. So you can see if you're just going to stay to the buy side of the markets, you're missing out a lot of times on 50% of the opportunity. And we have down here for interest rates mentioned earlier, this is Treasury bond futures. No buy opportunities according to this algorithm that puts out these, but there's certainly short opportunities, and of course you trade at your own risk. So that's basically how these work. If you're interested in following these, you get them absolutely free. There's a link in the description below. rbamresearch.com publishes them every morning before 7 a.m. We put out entry prices for 190 stocks, the major forex pairs, BTC crypto, and the most liquid futures contracts. Again, no credit card required. The access is free. The most important thing to keep in mind in this whole discussion is everything you've seen and heard on here is for entertainment purposes only. You can't use our entry prices for anything other than entertainment, and our analysis and discussion is all for entertainment. You have to do your own research. You have to fully understand buying and shorting. You can lose all your money very quickly doing either, and that's just the way the markets are. And of course, you can certainly lose a portion of it as well. You definitely trade at your own risk. If you like this video, please click the like button. If you want to subscribe, please do that as well. Keep in mind, we'd love to hear from you. If you have any comments in the comment section below, that would be great. We'd like to hear them. And again, remember, you trade at your own risk, and your broker and other financial advisors are your best source of information for going long or shorting stocks. You do so at your own risk.